Hi all, this is Akshara Menon from Famous Bazaar. I take the pleasure to welcome you all to Season 2 and Episode 1 of Alternate Universe. Thank you all for making our Season 1 a huge hit, which made us to commit the Season 2. And today's webinar is on the topic Emergence of Tech-Enabled Wealth Management Services. To inaugurate this, I would like to welcome the speaker, Mr. Srikanth Subramanian. Srikanth Subramanian, a co-founder, MD and CEO of Angel One Wealth, brings over 23 years of experience from Kotak Group, now leading tech-driven wealth management wealth platform at Angel One Wealth. He aims to serve India's emerging affluent HNI and ultra HNI segments. His diverse career at Kotak covered roles like life insurance, private banking, global wealth management, and investment advisory. Srikanth spearheaded Kotak Cherry, a fintech venture aimed at democratizing the investment access in India. He has been a pivotal figure in industry dialogues, contributing to key trends and serving on SEBI's working group for portfolio management regulations. Srikanth holds a bachelor's in commerce from Delhi University and MBA from Narsee Monjee Institute of Management Studies, Mumbai. Passionate about technology and disruptive steps. Moving on to the moderators of the day, Mr. Vikasam Sachdeva is an industry stalwart with over 3 decades of experience in asset management business. He is currently the managing director of Sundaram Alternatives, driving the growth across the platform's geographies and asset classes. And the next, Arjun Nagarajan. Arjun Nagarajan works at Sundaram Mutual as a chief economist and communications manager. With initial 3 years in academics, Arjun's career in equity markets spanned over 12 years, of which he has spent over 10 years at Sundaram Mutual. In January 2020, Arjun participated in pre-budget roundtable consultation with Honorable Prime Minister of India to discuss the policy measures for budget 2020 and 2021. With no delay, let me give the podium to Mr. Vikas. Over to you, sir.
Thank you, Akshara. Thank you to all our viewers. Like Akshara mentioned, this is season 2, episode 1, and we've had a great run in season 1. Thank you so much for your support. The original thought behind this entire series was to bring together thought leaders, in the business of creating wealth for investors in this country. And I think over the last 12 months, 12 guests, there have been several buckets of knowledge, insights, and perspectives which have come our way. Not only has each of these shows been patronized very generously by people like you, but also the YouTube videos have also attracted quite a bit of interest. In fact, I'm very happy to announce that very shortly, in collaboration with PMS Bazaar, we are looking at launching a book which will give you a sense of all of these 12 episodes, and insight into that. So with no further ado, let me just kickstart season 2, episode 1. And I must thank Srikanth for gracing the occasion. I think we couldn't start off with a better topic. Tech is the word of the day. And I think, like Akshara mentioned, you've had tremendous experience in tech. I'm also thankful to you for inspiring the school vibe. All of us are dressed in Friday casuals. So I think this was something which I'm quite enjoying. I'm sure people at my house are not going to recognize me, but that's okay. So Srikanth, we have this section called Person Behind the Professional. Okay. And we've spoken to people from your existing team, from your early teams, your industry colleagues. A little bit of hard work has gone into this, and I think it has been well rewarded. I'll give you some feedback on what your team thinks of you. See, the first point your team says that you're very organized and disciplined. Okay, not surprising, but you plan days in advance, sometimes even months in advance. At the very least, you have your next week's itinerary up and running. I talked to some of your colleagues, very young colleagues, and I got some very cool adjectives. So one of them said that your people management skills are next level. Okay, and I think that's a huge compliment coming from the next generation for this. You're very good at motivating people. You're very patient. You're a great orator. And what I actually agree with, you excel in the art of storytelling. I've known you for a few years, and the way you use anecdotes and examples to highlight a particular point or diffuse a particular situation, I think has been quite enjoyable to watch. You're a family man to the core and ensure that you take some days off during the year. Your work-life balance, you ensure that you maintain that, and not just that, your family, your colleagues' families as well. You maintain the work-life balance. Your wife Neetu who's a writer and is currently writing a book, and your daughter Zoe, who's the apple of your eye. She's 13 years old. Uh, you love spending time with your family. You often go out on dates with your wife, which I think is extremely sweet. You love throwing parties at home, and from what I've been told, you're usually the life of a party. Now, this is something I would have never been able to guess. Uh, Also, the fact that you're an absolute foodie, it doesn't show on your frame, Srikanth. In fact, you love kebabs, Sri Lankan hoppam. I'm trying to look that up in on Google. What is hoppam? And continental items. Okay. One of the other things which was interesting for me as we went along, I asked people about how are you in terms of a person and how do you get your work done. So work-wise, you're quite focused, quite aggressive, a go-getter, a taskmaster, all rolled into one. But this was said with respect, you know. But what gets your goat is when people deliver shoddy work, even if it comes on time, but the quality is not up to the mark. And I can completely empathize with that. Very approachable. You give a free hand to your teams. And lastly, just something which I quite enjoyed getting information about. You love the finer things in life. You have a keen understanding of music, arts, sports, and politics. Again, you love jazz clubs. I would have never guessed that. This is kudos to you. Keep your personal and private life so different. I would have never guessed that you love jazz clubs. You watch all sports, but football is your favorite sport. One thing, however, I guess today is your comfort fashion is casual attire. Okay. So, welcome to the show, Srikanth.
Thank you, Vikas. I must admit that's very sweet and very kind. So thanks for the lovely introduction.
So, let me just dive straight into the questions. While we put out the fact that we are going to be talking to you, some questions have come in from audience even before the show started. But I've known you for a few years now, so I'm taking the liberty of asking you this question. What I've seen is that you're a disruptor of trends. You actually try to do something which goes beyond the ordinary, and I think you latched on to the fintech bandwagon quite early. I think you're one of the few people who saw potential in fintech driving advice. You were managing Kotak Cherry, the fintech business, and now with Angel One Wealth. My question to you is, how have you seen these trends evolve over the years? I mean, are some of the trends which came in earlier norms now? Okay. How has consumer acceptance changed over the years in terms of accepting advice over the internet?
No, so because I think thanks for asking that question. Firstly, sorry, my voice is a little down today, but I'll try to make it as coherent as possible. Uh, I don't think I consider myself as a disruptor or anything. The only thing that I got very fortunate with is I started my career with Kotak fairly early on. I was almost just 21. So when you start your career that early, you can't afford to just do one job at a time. And Kotak was one of those organizations which allowed for a lot of horizontal latitude to people who joined. And I just latched on to the opportunities that were given to me. From initial days itself, I was very consumed that unless and until we keep reskilling and upskilling ourselves, and many of us have seen one generation above us, our parents, that what computer did uh, to our immediate one generation up was if you don't upskill yourself, some of these changing trends can disrupt us. So it was not about us disrupting trends or emerging trends, but it is just about us feeling comfortable challenging status quo, us feeling comfortable moving away from our comfort zone. And I was always sort of consumed by that. So first 6 7 years of my career in Kotak, I was in life insurance. And at that point of time when I joined, it had just been privatized in India after a long hiatus. So it was almost like working in a startup, and Kotak itself was a fairly young company. So you were in a startup industry. 6 7 years down the line, wanted to move into a slightly more domain-oriented business. So challenged myself, got the opportunity, was very fortunate, moved straight into a high-quality wealth management business, and fortunate to say that Kotak, for the longest time, has been one of the leading players in the wealth management side. But actually, the story went a little beyond that. Even within wealth, you have very clear positions taken in India where people are either outstanding relationship people or outstanding product people. And I somewhere believe that why can't one try to be both? Now, I don't know whether I can use the adjective outstanding or not, but I at least attempted to do both, where I spent equal stint in the product advisory research section and equal stint in relationship. How I did is a matter of another day, but at least I enjoyed doing that both. And I felt that that kind of challenge also brought about outstanding consumer insights. So it made you a better product person, and it also made you a better relationship person when you understood the nuances of both product and nuances of relationship. And that led me somewhere in 2018-19 to believe that at that point of time I was just touching 40 and thereabouts. I'm 44 today, and I kept thinking to myself that the way things are moving in life, medical sciences are going to keep us um alive for much longer than what, let's say, previous generations are. Lifespans are going to increase. Advancement in sciences are going to keep us um, uh, uh, alive for much longer time. And uh, if we don't keep upskilling and reskilling ourselves even now, then it becomes very difficult for us to stay till 90, 100. And old age can either be a boon or a bane. And with that, I thought, what is going to be the big emerging trend over the next 20 years is to get your digital quotient up. So actually today, I shouldn't claim that I'm a big fintech adopter or any of those things, but I just sort of challenged myself and moved into the right time in about 2019, 20, made that pivot. Again, Kotak gave me a huge opportunity to make that pivot into running a small fintech within Kotak, which then sort of grew to some size and scale of repute, called Kotak Cherry. And somewhere around 2023, uh, I was fortunate that I could see this massive tailwind in India, uh, uh, which I think all of us sort of subscribe to over the next 5-10 years, which could propel us to a very strong economy, stronger than what we are already. And at the same time, I also was fortunate to find a partner like Angel One and Dinesh, who had made that shift from being an incumbent to a completely digitally native firm. So for me, it was a very interesting intersection of, while personally I was making that pivot, here was a successful company who had made that pivot. So I said, why don't we start this entrepreneurial journey for 23 years with an outstanding firm? Next 23, 25 years, take all those value systems, but make that shift into a very digital first company. We've done wealth management of some scale. We've seen digital and technology up close. It was time to closely mix the two and start off in a new journey. So that's how the entire journey has been for me. And very quickly, as a rejoinder to your last question, uh, look, I think how investors consume financial products have undergone a huge change, but it's still just the beginning of what technology can do. Today, most of what we call as fintech, outside of areas around payments and let's say credit, in the manner of investments, is only a very product and a DIY approach. Pure wealth management, which is a very holistic kind of an approach, which is a consumer first kind of an approach, is still relegated to the offline world because it's a very high EQ business. So what we are trying to do is not to call the market too early. We think the winner in a high knowledge market, or a high knowledge industry like wealth, will be someone who balances fin and tech with equal measure. So when you say fintech, either someone is very tech heavy or we are very fin heavy. I think for high quality knowledge business, it has to be not one or the other. It has to be a balance between the two. So that's where we've started some work here, because
That's amazing. I think that was a very comprehensive answer to a question. And I think as we go along, we would want you to delve a bit more on some of these nuances. But outstanding relationships, outstanding advice, tech first. And these are some very we talk about this quite often, but I think a little bit more insight from your perspective will be really useful for our viewers. Uh, uh, like I said, we have a lot of questions, and I think Arjun is daring to ask you this question. But before I hand it over to Arjun, when you give us some insights, it will be nice if you could give us some insights more from an HNI, ultra HNI perspective. Okay, because this is something which I think our audience has also been asking for. Yeah, Arjun, over to you.
I'll take a quick question here. So when you're talking about HNI, the HNI space, so customer acquisition, that is something that really stands out. So can you share your thoughts on how you approach this sphere? And equally important, does being digital help in this HNI customer acquisition phase?
so two things. I think I partly alluded to this question when I was speaking to, because I think at least the hypothesis we make, and coming from almost a 20-year clear view of how UHNIs and HNIs sort of had behaved, and it could still change, but at least this has been our experiences. I think there are two clear demarcations I'll make. UHNIs are, in simpler parlance, what we call as people above, let's say, $5 million net worth, and just alluding to many pyramids that are made. But by and large, the market calls itself out as in a three-way tier structure. 1 crore to 25 crore, 25 crore plus is one way to look at it. So I'll keep it more in that region. The 25 crore plus segment, which can go all the way up to 100, 200, 500,000 odd crores of net worth, I think there technology will play the role of bringing the overheads and costs down, and thereby increasing productivity, increasing efficiency, increasing the ability of taking services to the investors at a lower cost, and hence, hopefully, not only creating a more profitable fintech venture, but also to take some of the services that you have been taking at a slightly cheaper cost. Because in most of the firms we see, most of the cost structures have been built keeping in mind the old revenue structures, and also keeping in mind a very brick and mortar kind of a structure. Now, both are changing very rapidly. What used to be a very upfronted revenue structure in wealth management era has quickly gone down to back-ended trail kind of a commission, whereas cost structures are still built in a way such that it is more front-ended revenues that will be justifiable, in which case it is ripe for someone to build and reimagine a new wealth management cost structures with keeping costs low, because revenues are going to take time and gestation periods have only sort of gone forward. And second, mostly what we see is that the direct cost that you incur towards high quality wealth managers has to be further validated with equal amount of OPEX expenses by keeping a very robust infrastructure. I think in this case, we feel technology can play a role where you can keep the relationship manager, the private banker, intact, because the role of a relationship manager and a private banker for very large clients will still be very important for the last mile validation. But all the support, all the OPEX and all the infrastructure that you usually build can be automated and brought down by using technology. So when we do these two things, when we build the cost down, and when we are able to create better quality products, again using technology and using automated execution services, your overall ability to have better time management, better service quality, better coverage, better reach can have a better experience and a lower cost. That is as far as the absolute top of the pyramid consumer segment is concerned. As far as the HNI is concerned, which I said just broadly to say, just slotting as a 1 to 25 crore kind of a segment, will largely comprise of equal measure, high quality salaried professionals, and also SME business owners. In this case, what we see is that these are usually clients who are fairly okay to jump into digital platforms to consume advice, consume products. And this is where we see an omni-channel kind of a model emerging, which means you will have to have presence on the street, because ultimately these are not small amounts, and they would require sometimes intelligent conversations with pedigreed bankers to test some of the hypotheses that they have, test some of the research ideas they have. But they may not require every meeting to be done in person. They may be okay to do meetings virtual. They may be okay to consume nudges, both predictive and suggestive, through apps. So I think it will again not be a one size fits all. We are trying to take an omni-channel approach, because this variety of investors are also what we think are the most underserved investors in India, because neither the technology companies are calling them out because they're only building single product line DIY, nor the very high quality private banks are talking to them because they're only servicing the extremely ultra rich. So today, good quality wealth management, unfortunately, is a privilege of the select few. So there, as I mentioned, we have a different model. We think it can work through high quality products and high quality tech. But in this case, most of the professionals, consider yourself, consider Vikas, all of us on the call, will find free time over the weekend. So when we want to actually sit and look at our portfolios, usually people are not working at that point of time. So there is a very strong play of technology by taking the wealth management services on a day, at a time when these investors really want to consume. You can also fractionalize and democratize certain products which are today only for the absolute ultra rich, and through technology bring it to a much larger fold of people. So I think as we go down the value chain of investors, role of technology from just being a support can come to be a very strong enabler. But one of the things that I must mention is our call is these kind of businesses which are extremely high on EQ and IQ will still depend a lot on good quality last mile dissemination. So at least we believe that we should not preach what the investor should do. We will make available both a good quality last mile in terms of a good quality RM, experienced RM, and at the same time, we will also have platforms like web and app such that the investor can choose how the investor wants to consume wealth management services offered by us.
Fair enough. So I can say that would be that differentiation that will make you stand out from, say, that of a private banking or of a private wealth management setup. Would that be a fair understanding?
Yeah. So look, Arjun, we're not sort of. I don't know whether it's really a differentiation or something, but it's something that we are very consumed with to build. At least these are strong insights that we have. If it creates any kind of value proposition differentiation for us, great. But we're actually doing it because after having done this for more than 2 decades, we are clearly seeing that sometimes when you take off, many of us who are thinking without technology believe that you have to have everything done through brick and mortar. And sometimes when we only use the technology lens, you believe that the actual benefit that a good quality RM gets can be disrupted. I think it is not either or. I think what we want to do is create an omni-channel presence and make the investor make the choice. If the investor feels that by jumping onto a digital platform like an app or a web, he or she is able to make informed choices. He or she is able to get accurate portfolios. He or she is able to look at a consolidated portfolio on the fly on a Saturday before your Liverpool-Arsenal game, before your football game, before your Wimbledon game. You want to get onto a flight. You still can't get your RM on call because it's 6 in the morning. If you still feel comfortable getting onto an app and getting accurate information, that's one big value add. Second, if nudges, if suggestions can all be given again through the app, and you feel, okay, listen, this is exactly what I wanted. So we will make the digital platform compelling and strong, but we will leave the choice of how they want to consume the services to the investors.
Fair enough. Fair enough. I'll come back again after Vikas. Vikas, over to you.
Thanks, Arjun. This is fascinating. I was listening to both of you very closely. In fact, at some stage, I would like to just delve into what you mentioned. I've been taking notes, by the way, Srikanth. Okay, you mentioned fractionalizing. Although we all know what fractionalizing is, but would like to hear you. But we'll come to that as we go along. Uh, I heard you talk about nudges. I heard you talk about suggestions. Okay, I have a slightly different question. All of this is possible when you're talking about a client's asset allocation, right? When you're talking about a client's asset allocation, uh, would you still believe that predictive analytics or the way a client has always been behaving would be the best way to decide his or her asset allocation? Or do you necessarily need to have somebody sitting down in person, taking notes and saying this is a high risk, moderate risk, low risk sort of a customer?
Yeah. So again, as I mentioned, because that investor makes a choice. There are investors who are extremely comfortable if they trust your digital platforms and they believe that, for example, trust. The definition of trust has changed. If trust used to be defined by the strong brand that you have built, in today's day and age, trust is also equally defined by how strong and robust your digital platforms are. So for many people who are just joining the workforces, who are what we call as either the late millennials or early Gen Zs, also believe that an app that works all the time. An app, when you push the buy button, executes the order. When you push the redemption button, executes the order. An app that lets you jump in and see what you want to do at any point in time is also a trust building mechanism. So once and an app which is always accurate, a which is always accurate. So definition of trust as we move along is changing for a lot of people. So if you always make sure that the numbers that you put out, the app, the platform that you put out, the advice that you put out has always got is always accurate, or is always to the best of your ability, trust gets formed. Before I actually answer this any further, I must also qualify that all this is how we think we will build. We are still awaiting our licenses, so it's nothing that we offer currently because it's just about a month and a half old. But when we get all the right regulatory clearances, this is how we think we will envisage, depending on how we get all our licenses in place. But whether an investor believes that it is right for the investor to sit across the table and do what is right basis of physical conversation, that's fine, and that's absolutely correct. Some investor may say that, okay, for the first one or two meetings, for us to understand each other well, let's do that bit. But as we get to know each other, and if I'm a very non-churning, a slightly more long-term investor, I think for regular reviews, we can meet virtually, and over periods of time, I'm just happy to just look at the app, and only for significant movements in my portfolio do I need to meet in person. That's fine. Then there will be a completely different cohort of customers who will say, listen, just give me great products. Just tell me what is right. Make your app extremely friendly from a UI point of view. Rest, leave it to me. So we really don't know what is right for which investor. That investor, of course, needs to make that choice. But we are trying to make sure that we cater to all three requirements. I personally, for the one, belong to the second camp, where I believe that when I sit and make a detailed wealth management plan for myself and my family, I would want me, my wife to sit. In my case, my daughter is still young, so it may not make sense right now. But in others cases, maybe they're one generation below. Sit, get that comfort with my banker, and understand that I'm in safe hands, or banker as in my investment manager, and get that comfort that I'm in safe hands. Do this over one or two or three meetings, and then move over to virtual meetings, and then completely move over to a digital kind of a service. But then again, as I said, to each their own. We're not consumed by only doing what is right, by trying to predict something, or by, I think, data science, and that is something that we have not spoken enough. Data science is something which we believe is going to have a huge part in what us or anyone with a strong right to win of using technology will have to depend a lot on. Now, for example, we all know that the technology stack of India is one of the best in the world. We've already seen what magic UIDAI has done through Aadhaar. We have seen what UPI can create. We are seeing early green shoots in ONDC. We are seeing in travel things like DigiYatra. We are seeing in terms of repository things like DigiLocker. And I think all of us know that the next big tech stack that we are all awaiting for, which is already launched, but we are looking at full adoption of it, is account aggregation. Once account aggregation in India is live, it changes our belief as to who owns the data. So far in India, we believed that the data is owned by either the intermediary or let's say the mutual fund or the PMS or the AIF managers. But account aggregation comes and puts the philosophy to rest. It says data is owned by no one, by the end investor themselves. So unless and until the end investor is comfortable that you can use the data of the investor to give them better services, either let's say in the form of cheaper loan or better quality advice or better products, they will not give you consent. And once they give you consent, after that, what do you do with the data will define as to how closely you will be able to offer a very hyper-local kind of a solution for your customer. So data science can take the data of, because over the last 20 years, which the data has so far been sitting with, let's say, any banker that you're dealing with, but because they have not deployed data science, they have not been able to give you your own services because there's so much richness of information. Now, tomorrow, a good quality fintech with a lot of emphasis on data science in one click of a button, gets your consent to use your data, looks at how you have behaved over the last 20 years, basis that comes and makes you a plan because they think that this is how you are most likely to behave. It will bring that affinity much, much, much easier for you. So I think that's how we think this will run. I really don't know how soon or how far, but I think we are waiting patiently. And that's why we said we are not taking a binary bet of offline versus online, but we are actually on the cusp of intersection of offline and online.
It's fascinating. I think I've been looking at the account aggregator space, but now that you put a layer of your perspective, suddenly it looks fascinating. I picked up 2 points when you were talking here. One is the fact of mass customization, if I can use that which will be possible through effective use of data science. And the other one, I think, which is very important, is the word trust. And I can actually quite empathize with that. There have been brands in the recent past which have done extremely well simply because they have a very robust technological stack and they've been able to deliver that service to the customer. And of course, talking about a robust technological stack, I think Angel One, I believe, has won quite a few reviews, quite a few positive recommendations from a variety of people. So I think this seems to be on the right track here. Before I just give it to Arjun, you talked about a customer. You talked about a customer from a variety of perspectives. You also talked about a customer where you talked about HNI 5 million and above. That sort of a differentiation you're given. And I understand you've got a license in the waiting, so I won't talk about your strategy now. But given your experience in the past, is there a definitive trend that you see that a particular set of customers, age-wise, net worth-wise, asset allocation-wise, tend to use services or platforms like this? I'm taking trust out of the equation because that is something you very clearly summarized. Is there a particular subset of this? Yes, please.
So I'm seeing, especially in the UHNI segment, which either you use it $5 million or 25 crore plus, whichever way. It's. I mean, metaphorically, we are talking of the larger sort of value customers. I haven't seen jumping on to technology platforms the way, let's say, the Gen Zs and the first time and the professional segments have jumped onto. They still believe trust in a very different manner. They still believe that, and it's not wrong. It's also right because we're talking of huge sums of money, and in that case, they like to consume financial services, wealth management services. Still, the older, I'm seeing as the generation baton passes, trends changing where the next generation of the family is okay to take advice, take products, subscribe to products through digital means. But I would still say it would still be about 10-15% odd. As far as investment trends are concerned, I think India is now turning out to be an extremely matured market as far as wealth management from an investor point of view is concerned. Despite we all talking so much about FNO and speculation and bubble kind of environment, but at least in the UHNI segment, we couldn't be more away from the fact to think that there is any kind of misinformation here. I think we've seen the real coming of age of Indian investor in the sense of how deeply they do diligence, how deeply they do research, how deeply they build their own in-house teams to make sure that they are able to invest into products, not with a short term, but with a mid to long term point of view. We've clearly seen trends of investors looking at investing from a diversification point of view into overseas assets through feeder funds available when they were, through LRS routes available as they are. So they are also looking at trends that developed economy investors have had, and they believe that to have such high home country bias may not be always correct. So that has been one trend that we have seen. The other trend that we are seeing is, especially over the last 2-3 years, certain sets of investors have realized that there could be a large portion of the portfolio which could also look at a combination of an active and a passive manager. And I think we've always seen this debate of active versus passive, and I've never understood that because there is no one or the other. It is always one plus the other, because only passive will never be able to generate that kind of alpha. And similarly, to believe that you have to spend a higher cost on a pure beta product is also not completely right. So I think this whole emergence of a very strong asset class in passive is also giving a big choice of investors to move a lot of their beta play into as passive, thereby leaving a very strong ability to dig deeper into products which are non-benchmarked so that they can look for higher returns. So there has been interest across alternative asset classes such as REITs. There has been interest in alternative asset classes such as private credit. Private equity, of course, has its own ups and downs. It's right now going through a small period of lull, but I think it is also, as India Inc. 2.0 on the private equity side comes, we will emerge only stronger. So I think width of products, ability for picking products with the right amount of due diligence, taking diversified bets outside of India, these are clear emergence of trends that I'm seeing. As far as tech is concerned, I think they are okay to consume technology from a portfolio reporting point of view, but the large part of wealth management still happens in a very in-person, one-on-one basis. It may change dramatically as we come down and we start speaking to people who are deprived of time, and that is where technology can play a far more robust role even in the front end.
Super. I think this is very, very insightful. I'm sure Arjun wants to ask the next set of questions. I didn't even realize how time is passing by, so I don't know whether we'll have enough time for the questions we want to ask you and go on to audience questions. But I'll try to squeeze in as much as possible, Srikanth. Thank you for this. Arjun, your call.
Yeah, I remember sometime last year on the Raj Sharma show, you made a comment that really stuck in my head. You said, apart from luck, there is no get rich quick in this world of investing. That's something that really stood out, and this digital trust component also something that really stuck in my head. So if I were to sort of look at the same answer that you gave to the previous question of Vikas's, in this entire world of investing, do you see any marked difference in how vintage HNIs approach investing? You talked about the millennials. Do you see any difference in how vintage HNIs approach investing and the HNIs that are of more recent in that sense? That was one. I'll just club it with another question of mine. From an organizational point of view, between instant sales versus deferred sales, or rather, to put it crudely, between near-term versus long-term goals, how do you sort of resolve this inherent conflict in an organization?
So, I'll take the second question first. I think we forget that wealth management, age-old, was always supposed to be a practice. It was never supposed to be a business. It's over time, because instant gratification took the better of us, we started looking at it as a business. But in reality, wealth management, like any other high quality knowledge business, was always supposed to be a practice. So which means if you take it with that mindset, you run it over periods of time. In fact, good quality private banking firms from Switzerland, from even back in the West, and even in India, have very intergenerational relationship with family, and that's how they actually grow. So I think it's a very new, and when I say new, I'm very mindful that 20 years is not new, but when I compare it to some of the other parts of developed economies, 20 years is still not such a deep history. So I think we are all going through trends, but ultimately the ones who will survive over a very long period of time are the ones who play for a longish sort of a thing. It is also culturally true that we as Indian investors sometimes also used to, and that is, I'll loop it back with your first question, used to look at sometimes short-term results, and thereby, whether it is the fact that we have a quarterly results as is anywhere in the world, mutual funds have daily NAVs and people keep looking at NAVs. There always used to be things of people used to be higher traders than investors, but I think there has been a dramatic shift in that. So I think people have realized that, especially people with access to good quality research, access to team, people who've been through many cycles themselves, the maturity levels are now at another level where they realize that you can get, and I'll read that thing again, that you can be lucky and get maybe hit a jackpot over short term, but really for us to consistently compound wealth over long periods of time, unfortunately, there's no easy way out. We need to be at it. We need to go through the grind. We need to see some ups and downs once in a while, and keep rebasing our strategies depending on context of markets, depending on context of macro, depending on context of how life has changed for us. I mean, life. I made an investment goal for myself uh, 10 years ago may not mean that the investment goals today will be valid. Similarly, when a wealth management firm is looking at a particular product, it may have very different connotation for someone who's just come into their first job versus someone who's just 1 year away from retirement. So all these things have to be kept in mind. It has to be the requirement, need, and context of the investor. It has to be the requirement, need, and context of what is to be needed to be done from a current economic, macroeconomic, and micro news point of view. So I think that's how we are seeing the change happen. But over 20 years, the amount of maturity that we have seen come in the investor diaspora is not funny.
Fair enough. Fair enough. Over to you, Kas.
So I probably have one last question before we get on to the audience questions, considering the paucity of time. Otherwise, I had a slew of questions, and I'll see if I can squeeze in one or two more questions after the audience questions. But here, so I heard you talk about touch points. I heard you talk about the human intervention versus the tech intervention. Uh, just one question which comes to my mind: while we are all trying to become more and more tech driven, but there are some regulatory formalities which are still very human driven. You know, uh, although reg tech is a very big segment, but at this point of time in our line of business, and I think I've been seeing some of these memes on KYC, etc., which are coming in. Okay, uh, do you think that at some stage all of these will also become tech first, or you will still need to have a human intervention coming in and validating your KYC, etc., etc.?
Because I'll be honest, in my experience, no one is more tech first or no one is more progressive than the regulators in India. I think the way they want to use technology for the larger benefit of financial inclusion is just amazing. And I think most of what we are seeing, this whole India stack is thanks to the right-minded forces that actually encourage that. I also believe that cyber is a big issue. Cybersecurity is a big issue. So I think we have to go through the grind of making sure that some of these odd issues like what we are recently seeing with, let's say, multiple KYC norms, etc. But I think it's just part of we moving towards a regime where we are able to use the technology but are also able to call out the evils and perils of technology. Look, we've been through 35, 40 years of very strong stock market history in India, but it is not bereft of its own sets of controversies, scams, and issues. Digital and technology is just started. So for someone to preempt and be a little, and if I can use a slightly stronger word, even paranoid may not be wrong totally, because what kind of evils await us, we don't know. What kind of cyber frauds can happen, how gullible investors can be sometimes looped in, we don't know. So while I know at times in this, unfortunately, in this era of inundated social media information, sometimes some of these things can be blown out of proportion. But I think, frankly, regulators know what they're doing. It's a matter of time they will get a grip on it. And if while doing that, it is no different. I stay in this suburb in Bombay called Bandra, and the famous joke there is that every road there is dug up. But as long as you know that it is ultimately going to be done for the greater good, and there'll be a time when the new infrastructure will hold us a better life, we are okay to pay that little bit of a inconvenience fee. So I think as we go towards it, we need the regulator to also protect us, right? So I think there will be one or two such issues that will always come up, but it is all done with the right intention. And I'm very happy, even though with a tech first company, to go through some of the grind. And ultimately, when we emerge as a tech first infrastructure as an overall country, if we have been able to remove as many perils and evils the technology by preempting some of these, I think it would be a win-win for everyone.
It's a beautiful thing which you mentioned, and I completely concur, which is what I wanted to bring across to our viewers also, that uh, the regulator actually knows much more than what we can comprehend. And, there have been instances in the past wherein some regulation is coming and we wonder why this regulation is coming in. Are we being over-regulated only to be followed by some data or some incident which happens a few months down the line, which makes us believe that what happened through the regulator was very good. So I think we should just support the regulator, like you rightly mentioned, along the journey. And by the way, Srikanth, I also like to think that while we are the first in everything, we need to also not be first in some things like trying to be completely digital in terms of KYC. There's always a benefit in following some other countries and their experiences in terms of all of this. That was very aptly put. So, Srikanth, I'm going to straight away jump into audience questions. And I must tell you that there is a prize for the best question, which you will have to choose. Uh, I'm getting some questions like how different is your business going to be from Kotak Cherry, etc., which I don't want to ask at this point of time. Uh, so Aksharaj Sarvanan asks, I think you've answered this question. What advice would you give to investors considering transitioning to tech-enabled wealth management platforms? You've actually alluded to quite a bit, but if there's one line you would like to repeat on this, it will be useful.
I think use tech-enabled platforms to minimize information arbitrage. I think there is one thing that I've learned over 2 decades is people make sometimes bad choices because of lack of information. So one thing that tech firms can do very well for you is give you information at your choice of time and place, and there is no dearth of what kind of information arbitrage can be minimized doing that. So I think that would be my one-line answer, that use tech-enabled firms to minimize information arbitrage for you to be able to make an informed choice.
Amazing. I have a question from Tejas H, which is he's asking, what is the next tech product you see disrupting the wealth asset management space apart from AI or specifically generative AI? And I can tell you, Srikanth, if I dig through this question a little bit more, the more obvious question is, what do you think of crypto?
Well, look, and as I said, in India, of course, we have a very clear position that we're not sort of really looking at crypto right now. But I think overall, I'm a big believer of the technology that is supporting crypto, which is blockchain. How crypto has the ability to really democratize and decentralize fiat currencies, jury is still out. We usually, in pure wealth management kind of a thing, we don't ever say any trend is good or bad, but we have to see it in the ambience of both what the regulator is thinking about it, and which again, when the regulator thinks about a particular investment case, they're thinking from a consumer lens. So at this point of time, we don't jump into it, but we are seeing around the world crypto having gone through its one level of downturn and then coming back strongly up. It's a very interesting use case of whether crypto can really challenge the established currencies of the world. That is on the crypto side of it. As an investment use case, as I said, we don't really sort of cover crypto that much, but the use case that crypto will throw open to the world is the technology that supports crypto, which is the blockchain. And I think the use case for blockchain is a technology which currently crypto has jumped onto and used. And we usually know a use case of blockchain as crypto, but the technology itself has got arms and legs to do services and to cater to new products which are unimagined today.
Interesting. I think in any case, you answered Sweta V. Sharma's question, which was alluding to both blockchain and crypto as technological wonders. You've actually used those terms. So I hope your question's answered, Sweta. Mahendra Prajapati is asking that he's currently facing issues with the HNIs in terms of commission transparency. What's your vision to grow Angel One as distributor or RIA?
So we envisage to have both services subject to all our licenses being in place, and we will let the investor choose. The regulator in India has made it very clear. The rules are set as to what do's and don'ts apply for anyone consuming wealth management services as a distribution client versus anyone consuming wealth management services as an advisory client. The fiduciary and advisory is a lot. And hence the right ecosystem is in place. Once all the right things are in place, we will let the investor make a choice of whether they want us to be advisors or whether they are happy to look at it from a distribution or product by product approach. And that is how, for everything, as I said, one of the things or one of the soul of what we will do, whether it's on technology or on business model, is to make most of the services and products available, most of the technology and non-technology routes available, and make the investors decide what is right for them. But whatever we do will hopefully be of a high standard and good quality.
So Srikanth, I think you're already starting to get your first set of customers. Sutirtha Chakraborty is asking, will Angel One Wealth cater to non-HNIs? I mean, retail investors between 10 lakhs to 1 crore investable capital.
Yeah, look, I think our parent partner in this case, which is Angel One, is already catering to certain sets of customers. So we are looking at customers without sort of saying that we won't service to any customers or not, but the way the range of services will be driven through technology, and that is the beauty of technology, that a technology never differentiates between customer coming from city A or city B, customer coming from net worth A or net worth B, customer coming from it's the greatest equalizer to our mind. So I don't think we are going to call out. And this is one thing that we've learned from very successful technology companies, that you don't differentiate customers basis any of these things. You offer customers through the right technology and let the customer decide whether this product or services is meant for them. So we are not going to differentiate between multiple customers. One of the reasons why we are wanting to use technology, as I had mentioned previously, is to take it to much deeper and wider areas than what without using technology we will ever be able to take to.
That's a very interesting answer. Amar is talking about Gen Z. Will they want to meet wealth managers in person? Amar, I think that question has been answered brilliantly when Srikanth spoke about trust, and you should watch this video later on. AS is again asking about the acceptability HNIs have to accept wealth advice. I think you also answered that. I don't think this is a good one. Pavan S is asking a question, and I'll just paraphrase this question. How do you identify the best tech-enabled wealth management service? Is there a platform? You have manufacturers which are being enabled all the time. Ouch, I can tell you that. But is there something to differentiate between good tech-enabled wealth management services?
As I said, I think one is most tech-enabled platforms today are excellent in terms of usage of technology, a great UI, great UX. So first, as a consumer, you should see whether you feel comfortable using some of these tools for yourself, how the data is presented to you, what kind of products you see. But the second, you also have to ask a question, and this is something that I genuinely, very personally, deeply believe in. Let's take an example for a minute, and I'll take a half a second departure here. That if someone near and dear to us is unwell, if it's a very common cough and common cold and we don't worry about it, it's low-grade fever, we might be quite okay to jump onto an app and take a physician's advice and maybe even pop in a paracetamol. I mean, but if some near and dear one has a very serious ailment, a cardiac ailment, or any such ailment that we are really worried about, I don't think anyone will just jump into a tech-enabled platform and just have a very faceless or a very virtual conversation and go for any major surgery like that. Why should money management be any different? So unless and until you're exceptionally sure that either the individual or the firm through whom you are consuming your services gives you the confidence of high pedigree, high domain, you feel that the quality of product, services, research, advice, as the case may be, is of a quality that is of highly trustworthy in nature, you should find that. So I think when you choose a good tech-enabled platform, you should not just choose for a gamified approach or a UI. That's just one part of it. You should also choose for what domain capability it brings, and do you feel that not only are you getting a very high quality product and advice, but also given it to you in a very tech-friendly manner. So it has to be an equal measure of both is what my limit. At least that's what I would have done if I would have chosen a tech-enabled platform for myself, that not only looked for good technology-related areas, but also looked for good domain-related areas, information arbitrage minimization, good quality products, portfolio consolidation in the way we want, and both width and depth of product choices available to me.
That's an excellent answer. If I can probably supplement what you're saying, I think as the market is growing, you will find more and more players coming in. It's only when the dust settles, will you get to know. Maybe if a correction happens, or if some investment avenue which is being recommended has done very well, not so well. So I think one has to be patient. You mentioned about information arbitrage. I think that's also a very good point. Uh, my personal my personal moment of truth in this entire conversation was how you define trust. Okay, and just to build on that, when you talked about information arbitrage and all of that, uh, how a consumer believes a wealth management tech app is servicing him in terms of information, in terms of insights, is going to be the one which is going to succeed eventually. I had a great time, Srikanth. This was fabulous, fabulous learning for me, as I'm sure I'm speaking for my colleague Arjun, as I'm speaking for the audience. Before we go, which is the question you'd like to give, an award to, a prize to?
Actually, I thought the last question made a lot of sense because there are so many solutions and so many platforms available. So, how do you choose a tech-enabled platform? I thought was a good answer, but I leave it to you because.
No, I completely agree with you. So, Mr. Pawan S, your question wins the your question wins the prize. So, thank you so much for your question. And we come to the end of our session. Srikanth, thank you so much for your insights. This was awesome.